Well, thank you all four of you for being here. I don't know who's all on the online, but hey everybody, I'm Tanner. I'm the new lender. Thanks for jumping on, and we'll go quick on this recasting. Do you guys know what recasting is?
No.
What?
No idea.
It's taking an original loan back after its original term, isn't it?
Essentially, close. Well, do you guys have any questions really before I start? And if you guys have anything, just start talking in the Zoom too, because I'm not used to the whole camera and the Zoom thing too. But anyone have any questions? No? All right, we'll just get going. All right, so what recasting is it's the process of applying a large amount of money to the original loan and then redoing the principal and interest based off that amount. It's very common right now. It doesn't shorten the term or the interest rate, so everything stays the same on the loan, but your principal and interest will be reduced, and so your monthly payment will drop. It's very common right now in this particular market, and we'll get to that in a second, honestly, but it saves your borrowers a lot of money. It makes it where they can be non-contingent, and that's the whole point of recasting and why we want to do this today, is to show why it's beneficial in this type of market. But it's essentially putting a large sum of money, anything greater than $10,000 down to reduce the monthly payment once you're already in the house and in the loan. What products are eligible? The only products eligible, it has to be a conventional loan, Fannie or Freddie. It can't be a USDA, government, FHA, VA, any of those, anything government owned. It has to be a conventional loan in order to do this, because one, most borrowers that are doing it have the money, are conventional already, because you do have to have a lump sum of cash to be able to do this. So conventional only, but it does help those people out as they're trying to find a house in this market. Some different guidelines when you are recasting you have to write a request for it to go through. You have to submit it to their current servicer. When you're with Fairway, we service the loan. I don't know if I'm on the screen or not. It's okay. At Fairway, we do service the loan for anyone that wants to recast. When I have a borrower that's considering it, I show them what the benefits of it could be. I put them on with our own team, our own servicing team, so we don't sell our loans when we recast. That way they can hold on to it and we can do it in-house, and it's a lot smoother process. You have to put a minimum of $10,000 down. You can put as much as you want down to it, but you have to put down at least $10,000. There is a small fee of $250, but they just add that on to the end, so you know that you have to pay an extra $250. You can only recast twice on the same loan, so you can't just keep putting more and more down and redoing your principal and interest. You can only recast twice, and your loan has to be on time and payments have to be made in order for you to be able to do it. A big thing with the recast is PMI removal. I'll show you an example here in a second of why this actually matters to you, but a great example is someone puts down 5% on a house. After they put down that 5%, they turn around, do a recast to now get that loan to value from 95 down to under 80 so that the PMI falls off. That is part of the recast process. They do have to write another form of it, but it's huge in this market and right now that you could get in a house, only pay PMI 1 month, and then turn around, do a recast, and be good to go. Small timeline. It usually takes 4 to 6 weeks after you submit your process. After you start the process, the paperwork, start the recast information, it takes 4 to 6 weeks. So you'll have to make one more payment on the mortgage before the new principal and interest balance will be affected. And well, I like that. It's a good ringtone. It's okay. It's literally S3, so it's okay. You must make your first payment to your servicer. So when you get a mortgage, I don't know if this is facing me or not. On Zoom, can you see me, or you can see the screen? You don't need to see me. But you have to make your first payment on your mortgage. So when you buy a house, you close, let's say you close June 1, you give us June, July, your first payment's August 1, you have to make that first payment, and then you can start the recast process. So essentially 3 months after you buy the house or get in your house, you can do a recast. Okay, so now the fun part. Do you guys have any questions about recasting on that? That's just a little guideline basics of it. This is where it actually involves you guys. So how does this benefit my client? So this is where I'm kind of new to this as well. You guys tell me, when you go to a listing appointment, what options do you give someone that you're getting? It's a sell and buy situation. So they're going to sell their house and use you to buy as well. What all options do you give them as far as a timeline of when we should start listing? Do you leave it up to them on let's list and then let's buy, or how do you guys do that?
Ask them their preference.
Kind of depends on the situation.
Their situation, yeah. That's kind of what it says on here. There's multiple different ways, right? This is from Liz sent me this. Let's just say so. So there's different ways, like you guys were saying, to get to that end date. There's multiple different options. There's the contingent option, which is, as you all know, you sell the house that you're currently in, use those funds for the down payment, and then you guys will be able to close on the same date, make it contingent. Non-contingent, if they have enough money, you can do that as well. You can sell the house, then you can go out and buy. Where this comes in to really benefit in this market is, let's say you have a good seller, someone selling their first home. Okay, so they're selling their first home worth $250,000. They have $100,000 in equity in it. This is actually an example I'm doing right now with someone in this office. We just got a call yesterday to do this exact process. So you're selling your first home. You have about $100,000 in equity in it. Your new home that you want to make an offer on is $400,000. It's a good qualified borrower, someone that's a conventional loan that has money in the bank. They have money that they could buy this house at without selling their current house. So you put in an offer, 5% down on the house with so $20,000, and make it non-contingent because they're a conventional loan. They're good to go. They don't have to sell their house in order to buy this one. Make the offer at $20,000 down. They get the offer. You close on the loan with you putting $20,000 down, 95% LTV, a 30-year rate at 2.875 or whatever the rate is at that time. Okay. Then you turn around after you get in the house. While this is going on, you have the listing go get under contract. You close on that sale and you get $100,000. When you get that $100,000 at that time, you can then do a recast. And when you do the recast, you put that $60,000 down onto the loan. It pays down the PMI, gets you down to that 80% mark instead of offering the 20, and it allows you to get to that 80% mark without being contingent because you recast. Your new principal and interest will be based off this 80% LTV. So your PMI is gone, your principal and interest is reduced from about 15%, which is essentially on a $400,000 home or $60,000. That right there is $300 plus PMI is gone. So it'll save them $400 a month, but they can get in a home non-contingent. And so in this market, as a lot of you guys know, well, everyone knows that if you have a contingency, it's going to be pushed all the way, probably pretty low on the file, right? And so if you have the option to recast where you can have someone be non-contingent and then turn around and use the proceeds, and all they have to do is make one payment at the higher payment and they'll get the house, then it's extremely beneficial to have in your pocket.
A lot cheaper than a bridge loan.
Way cheaper than a bridge loan. Those rates are crazy right now on the bridge loan. And you sometimes get stuck making the payments for a lot longer than you would. Especially when this, like you said, if you make one payment on it, then you only have one payment of $300 higher than it would be, and you get to put $400. You get to save $400 a month after your third month, after your first payment. So, does that make sense? I know it's super fast. Recasting does not have much to it. Anytime that someone would apply with me, we get to see their assets, everything, if they're conventional, their credit score. So we will see if recasting is an option. And if it is, we will present it to them and let them decide if that's something they would want to do. Just because it does make sense in this market. You're not going to win if you have a contingency. You're not going to win. And there's no need to be contingent if you have a 780 borrower with money in the bank. So that's really it on recasting. I know it was simple, super quick and to the point, but it is very beneficial in this for you guys to use right now. Does anyone have any questions?
So 780 a minute, is that
That was just me saying.
credit score?
No, you can do, it's anything conventional. So you could get in with a 640 if you have money in the bank. It's all about the money in the bank, and if you qualify conventional. Usually I try to have people be below 680 to be conventional because it's a huge difference in rates. But if that is an option, they can go down as low as 640 for Freddie and Fannie. Questions on recasting? Is there anyone online? I don't know if y'all are seeing me. Oh, there is people online. Wow, there's like 5 people online. Hey guys. Will someone say hi? Just so I can hear you say hi.
Hello.
Hello?
Hey!
There you go.
There we go. Do you guys have any questions? I went really fast. I don't know if y'all saw me or the screen or what you were really seeing, but
No, we see you. We don't need to see the screen because it's on our screen.
there you go. Okay, good.
No questions, but hello.
Hello. Thank you so much for joining us today. I wish y'all could come get a sandwich, but
So is this a Fairway thing or?
it's everyone. So you don't have, it's not with Fairway. It's with everyone can do it.
What's a bridge loan?
Oh, what's a bridge loan? So that's getting a loan in between selling your house and buying your house for that extra money to put down. Essentially, so then you can put 80% down and you can be non-contingent. Does that make sense?
Like do the purchase loan with 80%, well, 80 or 70 or 60 and an ELOC up to 95.
So you're only putting,
You have 2 loans and then you pay off that.
does that make sense?
Oh, so it just covers the gap of.
It covers the gap to 80%.
Okay.
Yeah, where recasting, it's beneficial where instead of getting a bridge loan, you can get in at 95% and then you make one payment. And as soon as you make one payment, you turn around and recast and you don't have to make that payment anymore. Your PMI's off, your payment's $300 less. So it's just one payment higher and you're good to go.
I mean, interest rate's a lot. It's a 30-year term and a lower interest rate because it's a first mortgage, not a second.
Exactly. So,
So, I mean, to qualify though, you need to have the cash.
correct. You'd have to
And-
qualify
So what would
non-contingent.
what would the qualifications be?
As in, you'd have to qualify as if you're holding on to both houses. So
Okay.
if let's for instance in this example, you are holding on for the $250,000 house, just like it is an investment property. So you'd count it, qualify as an investment property, and then you'd have to have enough money in your bank account to have 5% down. So if you have $20,000 in the bank and your debt to income is not too high, then it's a great benefit. So it has to be a conventional qualified borrower for them to use this product. But if it's someone that is, then it's a very beneficial in this market, especially when you get into that 400, 500 price range, as you don't have to be contingent at all. So
Can this be used as an investment, like buying investment properties or just personal?
it can be investment as well, anything conventional. You do have to, no, it's the same. As long as you put down more than $10,000, you're good to go. So, but at the same time, it wouldn't make sense investment. You could do it. I mean, you can do it on any loan, but not at the buy because you're putting down 25% or 20% to get an investment property already,
Yeah.
just to qualify for an investment. But you can do this on any loan of yours that let's say for instance, you have a great month and you make $50,000. You're like, I don't know what to do with this money. That'd be amazing. But you say, I'll put $20,000 towards a house. You can do that and it'll drop your principal and interest and save you $100 a month for the rest of the loan. So, questions, anyone? Well, thank you guys for joining us. It's our first little questionnaire recasting teaching lesson. If you guys have anything you want me to teach on or in the future in the next few months, let me know, or any questions on anything. My office is right outside the training room here, or just shoot me an email, give me a text, and I'll answer any questions that you guys have. So thank you all for joining us.
I do have one question. Sorry to sneak in at the end. I have seen this page before. Is this available somewhere for download?
Yeah, they just sent
Oh, perfect.
this exact PowerPoint out this morning. Elizabeth did, and
Oh,
I can
then I
send
got
you.
it. I got it. Yep.
Cool. Yeah, she sent it out this morning. It has all these slides on it.
Perfect.
So
Thank you.
absolutely. So you guys will have access to all this. So, and if you have any borrowers right now that are looking at it, just have them give me a call and I can get it all settled up for them. So. All right, guys, that's it. Thank you guys for joining me. You don't have to clap. Don't clap. Bye, guys.